All right, we are at 4 o'clock and we're excited to be with you. We're going to go ahead and get started with our March webinar. We're glad that you folks have joined the line with us, and we look forward to providing some useful information today. I'm Greg Patterson, and I'm joined with my teammates J.A. Kennedy and Tara Gould, and we are with Atlantic Wealth Management. And our goal in hosting these webinars each month is to bring updated market information, economic data, and some actionable ideas that you can take away from this. We hope also to provide some calm reassurance in spite of all the volatility, and provide some insight on where we think we're headed, and just really relay some up-to-date and timely news. So with that, we want to go ahead and get started. As in past broadcasts, we like to remind you, if something happens with the technology, either we get kicked off or something with our internet happens, just stay the line. We'll come back to you just as quick as we can. That's usually the best course. Also, if you have questions or concerns or anything on your mind, feel free to email us. You can always do that at McKenzie@myatlanticwealth.com, and that's spelled MACKENZIE at myatlanticwealth.com. And Mackenzie will route those questions to us, and we'll get those answered just as quick as we can. So today we've got a lot to discuss, so let's just get started. We're going to cover current market returns. Tara does a great job at giving us an up-to-date look at where we are year to date and over time. Also, we're going to talk through economic data. Jay's got a host of data updates that he'll share with you, and that includes our U.S. recession indicators dashboard, short-term and long-term. We'll also talk through the leading economic index by the Conference Board, and that's updated every 30 days, so we'll get a current assessment on their index. And then banking inflation and the Fed. This is the $65,000 question on everybody's mind. Is this 2008 and 2009 all over again? Or is this something different and, like Janet Yellen says, very much contained? So we'll talk through that and share our opinions. And then lastly, key takeaways. We're going to give you some actionable ideas that we think would be important in this time period. And again, we'd love to hear your thoughts as feedback. So that's our agenda. Let's kick it off. Tara, give us an update on where we are with the S&P 500 U.S. equity markets.
Of course. So I always like to start here, and this is the first chart we're going to look at is the S&P 500, and this is going to be year to date, so January 1st through today. Remembering that S&P 500 is the 500 leading publicly traded companies, and this index is based off of market cap or market capitalization. You guys are going to hear us commonly quote the S&P 500 because it is considered one of the best gauges of the U.S. equities market. So what we're looking at here is most recent year to date. First, I want to start with the market low that occurred early on in the year. So that was Thursday, January 5th, and we were trading around 38.08. The high, if you just keep going to the right a little bit, that occurred on February 2nd, and that was at 4,179.76. And to give you an idea for a year to date until now, we started the year around 3,800, trading the S&P 500, now currently trading above 3,900. So that puts us a year to date increase of over 3%. Next up, we have NASDAQ. The NASDAQ is just another index. It's the staple of the financial markets. This includes about 3,700 companies, stock, and this is going to be heavily weighted towards technology. So NASDAQ, kind of similar to S&P 500 with regards to a low. This was on January 5th at 10,305. And then the high you can see peaked, at least year to date, February 2nd at 12,200. When we started the year, the index was at 10,386, and we're currently, as you can see, trading above 11,600. So that puts our year-to-date increase at 12% on the NASDAQ.
Now for the update on economic data. Every week there are a number of economic reports that come out. Most of those happen once a month, and they're for a previous month, and they tend to be a little bit lagging in terms of timetable. But we do pay attention to the most up-to-date data that we have. And as we've mentioned on the last few webinars, it's kind of a mixed bag when you go through this list of things that we would say are at decent levels versus those things that have been hurt by current economic conditions and situation. So just want to give kind of a high-level overview of each of these items, jumping in with inflation to start with, which has been just a big reason for what we've gone through over the last year, 15 months, 18 months, that has hit everybody's pocketbook when you go to the grocery store or the gas station or spend money on anything else, really. What we have seen, though, the latest update, the inflation numbers for February were year-over-year decrease. So if we look back to July of last year, 2022, we topped out at 9.1% year-over-year inflation rate on the CPI, which measures consumer prices, so what you and I would spend on goods. And then, so from 9.1 July of last year down to 6% year-over-year was the latest report, and that was down from the prior month, 6.4% down to 6%. So the trend has been just a slow, gradual decline in the year-over-year inflation number. The PPI, which is the producer price index, it measures inputs or wholesale prices that producers pay. We kind of look at that as a leading indicator of the CPI, because ultimately, if producers are paying less, hopefully those price savings or those cost savings are passed along to consumers. And the last report on the PPI wasn't even more encouraging than the CPI. It went down from 6% year-over-year down to 4.6% year-over-year. So, and the PPI topped out last March, so a year ago, and that was well over the CPI number. I think it was in the 11% range. So quite a bit of movement over the last 12 months there. And the key here is that the trend is in the right direction, albeit, it's happened slowly over time. On the employment front, the jobs report for February did come out Friday before last. We grew over 300,000 new jobs, and the unemployment rate did tick up slightly from 3.4% to 3.6%, but still at a healthy level. And we do look weekly at the initial jobless claims. Historically, they have been kind of a precursor to worsening conditions in the job market, and they've continued to be at relatively low levels as compared to just historical norms. Housing market, clearly the housing market has been impacted by interest rate increases over the last year. We did see that housing starts increased in February, in the month of February, but they're still down about 18%, I think, year-over-year. And similar data, on existing home sales, new home sales, house prices, we've seen declines across all those different areas. Retail sales have continued to be increasing. The retail sales number that came out for last month was a 5.4% increase in retail sales. We like to look at that in comparison to inflation. So prices are up 6%, retail sales are up 5.4%. We're basically just keeping pace, or not even quite keeping pace, with the rate of inflation. But consumers are continuing to spend, so that side of things is encouraging. Mm-hmm. Industrial production has been an area that we've seen decline and is still in decline. We saw the number unchanged month to month from January to February, but it's still at lower levels that we've seen in a while. And then GDP, gross domestic product. We look at that from a economic growth standpoint. What is the rate of growth of the goods and services produced by the overall economy? And we mentioned there has not been another revision since our last webinar call, but the fourth quarter annualized number on economic growth is 2.7%. We should have a last final revision coming out the end of this month. But we would say that is a healthy rate of growth. Again, that's fourth quarter. I'm not sure what the estimates are for the first quarter, but we'll be paying attention to that as we wrap up over the next couple of weeks. We'll be concluding the first quarter, and I'm sure we'll have a lot of data to sift through in terms of estimates and forecasts. And then the Fed is the last bullet there. We're going to touch on that, but the Fed has been at the crosshairs of all that's really gone on in terms of this rate hike cycle, dealing with inflation, whether or not the Fed was late to the ball game. What are they going to do next? And we'll talk a little bit more about that as we continue on. Now, what everybody's been waiting for is just some overview about what's happened over the last couple of weeks with regards to these banks that you see listed here that have definitely been in the headlines. All of these, all of them are somewhat different situations that we just wanted to touch on to provide some color about what has happened in each of these situations. Not to go into a ton of detail, but just to give you some background on that. And Greg and Tara, feel free to jump in if I miss something or leave anything out. But really, this all started Friday before last, the 10th of March, really with Silicon Valley Bank. And really, it was a liquidity issue with Silicon Valley Bank. They are a relatively young startup bank focused on venture capital in the technology sector. So they were raising money and providing funding for a lot of these technology companies. Interestingly enough, only 3% of the funds in that bank were FDIC insured, which means there was a lot of large balance accounts in that bank. What happened there is they didn't employ proper risk management in terms of what they invested those deposits in. And as the value of those investments went down, as we saw rate increases over last year and continuing into this year, they had a liquidity issue. And it's kind of a snowball effect when word gets out of a liquidity issue in a financial institution. Folks start taking their money out, and then the bank's forced to liquidate securities at a loss. And that's kind of what the situation we found ourselves in with Silicon Valley. Mm-hmm. It was the 16th largest bank, I think, in the country, but again, kind of focused in a niche market and a niche clientele.
Yeah.
Go ahead.
No, I was just going to say in tech. That was their niche market.
Yeah, technology.
Interestingly enough, too, I think it's noteworthy, J.A., none of our households or clients owned any of their common stock, nor did we have any of their CDs. So we commented as a team, we really had not heard of the name Silicon Valley Bank prior to this whole event happening.
Yeah, that's right. First Republic is the next one there, and this somewhat similar to Silicon Valley in terms of the clientele, upper scale clientele. They had more than 3% FDIC insured, but 2/3 of the bank assets were not FDIC insured. That means the accounts were over 250,000, the majority of the accounts, because that FDIC insurance does go up to the $250,000 mark. And First Republic is the 14th largest bank. They have not been bailed out, but we've continued to see their stock price go down. Another issue with First Republic is that they have 111% of loans to deposits. So they're highly leveraged. And again, it goes back to what I mentioned with SVB. When word gets out, negative news things tend to snowball, from that point on. So we're yet to see. We'll see the final resolution of First Republic Bank. Signature Bank, that is a situation where a lot of the assets there at Signature Bank, and many of these are similar circumstances from the standpoint of they're kind of more niche banks as opposed to your national banks, that we would all be familiar with the names on that list. But a lot of the customers of Signature Bank, in fact, I think 20 to 25% dealt in the cryptocurrency business or field. And so as values have gone down over the last 6 to 9 to 12, really probably the last year in the cryptocurrency space, folks that have been highly involved in that area have been hit, and the bank has taken a hit again. And that, again, it goes back to the niche aspect kind of these banks. The latest one over the weekend was Credit Suisse. Swiss or Swiss? How do you say that? I don't know. Is it Swiss or Swiss?
I think most pronounce it Swiss.
Credit Suisse. And
that's the US pronunciation.
Yeah, there we go. So the issues here stem back from a year ago where they had a hedge fund to go under. And then if you look at the stock price, it has slowly come down over time as there's been fallout from that. The latest instance or issue that resulted in UBS needing to purchase or buy them out was that there was a Saudi backer, financial backer, that refused to or stopped their backing. So a major financing source ceased to be a financing source, which then created the need for another financing source. And UBS is the bank that a deal was brokered between the two. So that's kind of a high level overview of the four that have been in the news to this point. Greg and Terry, you guys have any other?
I was just going to say two things just to clarify FDIC and the amount. So 250,000 per account, per registration, and then per institution. And so if we have a husband and wife, a couple, and they can each have an individual accounts insured up to 250,000. They can have also a joint account, and that insurance on that joint account is higher at 500,000.
Yeah.
And go ahead.
Well, I was just going to say that is key, because in all of these situations, I think there's some level of quote unquote run on the bank scenario, right? Which I kind of mentioned, but you have negative headlines come out, people get fearful and scared, they go to take their money out. That exacerbates the issue that was already at hand from a liquidity standpoint. And what we did see was with SVB and with Signature, weekend before last, the government did step in to say depositors will be made whole, even if they have over and above the FDIC insurance amounts. So that's where we stand now.
Yeah, and we did send out a letter to clients, just really breaking this down and giving a detailed account of what happened specific to SVB. If you're on the call today and you're not a client and you would like a letter of that synopsis, please feel free to call or email us. We're glad to share that information with you if you want to know more details about it.
Yep. Moving right along. So it's interesting how what we've talked about with regards to the news in the banking sector and what's transpired over the last week and a half or so has changed market and economic and rate expectations, and how quickly that has happened. We just looking at the Wall Street Journal, this headline dates back to March 7th. So this is just a little before the SVP news broke. The headline says Jerome Powell says the Fed is prepared to speed up interest rate rises. Chair says U.S. Central Bank likely to lift rates higher than previously thought to fight inflation. He says they would consider raising interest rates by a larger 0.5 percentage point later this month, and was likely to lift rates higher than previously expected this year to cool an economy that has shown surprising strength. So again, this a few days before SVP. You know, it was kind of like we've still got our foot on the gas pedal. Expect a 50 basis point hike, and probably more beyond that. If we fast forward to last week, so this is just a short 8 days later after we've had SVP news, Signature, Republic, had not the Credit Suisse yet, but at this point, but come March 15th last week, contrast these two headlines. Bank failures, market turmoil, fuel bets on a pause in Fed interest rate increases. The shift in outlook comes ahead of next week's central bank meeting. Market bets on rate cuts as early as this summer. So we go from pedal to the metal with the Fed to now, you know, are we towards the end of this rate hike cycle? Could we be, you know, looking at a pause and then eventually a cut in the shorter term? Now, this is just over 8 days. So 8 days from now, it could totally flip-flop again, right? I mean, if we get a hot inflation report, I think the key here is that we are paying attention to, you know, the news, the latest news that comes out, but we are in kind of uncharted territory where we stand right now in terms of what has happened over the last 12 to 18 months, and knowing, you know, the path forward, where we are headed is difficult to predict, just as we have seen, you know, a dramatic change in expectations over the last week and a half. So we take into account, you know, what we know and try to look out the front windshield and manage accordingly.
Yeah, Jay referenced inflation as one of the major headwinds that we're facing. And this chart in front of you is the Fed funds rate history, just going back to the last major recession, that of 2008 and 9. And you can see how this blue line over on the left-hand side drops off through that recessionary time period. And we had probably 15 years of inflation at the Fed's target. In fact, the real conversation during that early time period, 08, 09, 2010, was deflationary. If you're on the call and you've paid attention during that time period, you would remember. Of course, we had some rate hikes coming out of 2015, but quickly went away with the coronavirus and the pandemic of 2020. That was dropping off of a cliff to near zero rates to stimulate the economy out of that. And the Fed, interestingly, you know, the money supply went up dramatically, 40% increase in the money supply during that time period in the form of all sorts of stimulus. And so it's no wonder that we have inflation coming out of that, right? We had a supply chain imbalance, and we had an increase in the money supply. That's textbook example for inflation. If you go back to the news reports, we don't have any slides of this. I think we've talked about it plenty of times before, but the Fed was poised to not raise interest rates until 2023, this year. Well, we know that did not happen. Coming into 2022, the inflation numbers were hot in March, and they began raising interest rates. This chart only shows it through the end of the year. We've had 8 hikes in a very short period of time. And it has created a situation where it's working on inflation. Jay mentioned the number 6%, the consumer price index down from the 6.4 reading for January. This is annualized, so looking backwards 12 months. And he also shared the PPI number at 4.6, which is really the input number. The CPI is looking at the output of what we're all spending at the gas pump and the grocery store and all those indicators that go in there. Their target, as the Fed Chair Jerome Powell has said, is 2%. And they're maintaining, I guess they're tasked with maintaining the 2% target as well as a fully employed economy. If they're going to stick to the 2% number, our thought is that they have some work to do before then. And just like the headlines on the previous slide showed, within a span of a week, the outlook changed. So we'll see. The 22nd this week is when they release their next report. Our assumption is that they will increase rates, but of course, it's really anybody's guess on that. So had you listened to our webinar last time in February, our outlook was 3 more increases and a decrease at year end. Again, I think it's anybody's guess at this point, depending on how deep this bank issue is. We think it's contained, but we'll see how it works out. What I will tell you is that with rate increases like this, it is providing some higher rates in the short-term market. In fact, the 10-year Treasury is less than the 3-month. And so it does provide some rates on the shorter end that have not been seen since 2008, really. So that's just a quick snapshot of the Fed funds rate history. I think it's important as well to look at leading economic data. We'll get into that, but first Tara is going to talk through the recession risk indicators dashboard.
Right. We've been looking at this each time that we get together for our webinars, just to see how things have changed. So recession, we know it's a significant decline in economic activity. And so we're going to see this spread across the economy. It typically lasts more than a few months. We're going to see it visible in real GDP, real income, employment, industrial production, retail sales. And a recession will begin after the economy reaches a peak of activity, and it'll end when the economy reaches its trough. And between trough and peak, the economy is in expansion. Expansion is our normal state of economy, and most recessions, as we know historically, have been brief. What this dashboard shows is it's 12 different economic indicators, and I typically like to highlight the ones that have shifted. And so you'll see a little panel across the bottom. We have a green arrow. It stands for expansion, the yellow circle, which is caution, and then the red X, which is signaling a recession. We began tracking this with our monthly market updates, and you can see just from the last column here, kind of what's changed. So you can see that since August, housing permits have turned to signal recessionary. Job sentiment has turned in order to signal cautionary. We still have a few hanging on as far as expansion, which is the jobless claims and also the truck shipments. So just a little bit of background also, once going red, the average is about 3 months before we enter recession. Based on current conditions, this hasn't happened. Past recessions, based on this dashboard, have happened up to 13 months after we've crossed over to signal recession. And then the last here is just to show you historically what the dashboard has looked like. You can see the 12 different variables typically foreshadow a recession in things like retail sales, wage growth, commodities, credit spreads. All of these are signaling or flashing risk right now.
And the U.S. leading economic indicators is another dashboard. We look at it. It's put out by the Conference Board. The Conference Board's been around since 1916. They're a nonpartisan, nonprofit think tank. And so they use innovative approaches that make you think and act differently. And I think for us, it really provides a clear indication of what's to come, not a crystal ball, but it is predictive of recessionary time periods. The blue line is these fundamental indicators that they're tracking for the US economy. And if you look at the gray bars, the vertical gray bars, those signal recessionary time periods. And so the blue line is indicative of that time period simply by updating those numbers every 30 days to put a plot point on this chart. We are all the way at the far right. February 22nd was the last update to this indicator. I'm sorry, February 23. And I'm not sure exactly the date that came out, but I don't know if we have it on here or not, but it's updated every 30 days. So it's the most current that you're looking at in front of you there. It did fall again by 0.3% in February to 110 on the index. It also declined 0.3% in January, and it's down 3.6% over the 6-month period between August of last year and February of this year. So it's a steeper rate of decline than its 3% contraction over the previous 6 months. And 8 of the index's 10 components were negative or flat in the contribution of the totals. So that gives you a quick snapshot of what has happened most recently. The banking sector turmoil has not been reported, so most likely this LEI data could be more negative if that banking sector, the issues in the banking sector persist. So overall, the Conference Board forecasts rising interest rates paired with declining consumer spending, and they say it will most likely push the U.S. economy into recession here in the near term. I think it's probably been the most anticipated and talked about recession on record. I think every leading U.S. economist and global economist saying the same thing, which is interesting because going back to 2008, economists were not in a consensus around the great financial crisis, quite the opposite. Many of them were predicting growth until the U.S. real estate market pushed the economy into the tank there. So contrast that with this time where many of our leading economists are all lined up predicting a recession, and they've used all the following terms as far as describing the landing as soft, hard, crash. I've even heard the term no landing.
No landing, yeah.
So, you know, I'm not sure. At this point, we know we have mixed data, but 8 of the 10 indicators are negative. So the chart really, I think, will reveal as we go through this that we are in fact either in recession or soon to be there. So it's, you know, it's important to look at this from a short-term nature. I think the key indicator, though, that we have to keep in mind, if you go back to the left edge of this chart in 2000, the stock market continued to grow even through all those recessionary time periods. So that's about 22 years ago. And we would say a full market cycle is about every 10 years. And for our clients, what we would say and continue to share in meetings that it's likely if you're in a equity-based portfolio with some fixed income, the majority in equities, is that you should expect 2 negative years of declines and 8 positive years, and that over time your assets will increase. That is regardless of this chart. You know, it's much like the seasons changing. We can't predict exactly when that's going to happen, but the general theme, as Tara pointed out, is expansion and contraction with peak and trough involved in that as well. So it's nice to be able to see this, but again, I think it's reflective of where we find ourselves today.
Well, and going back to your comments on the most anticipated recession, we could go back a year ago when rate hikes started, and there were folks that were predicting a recession the first part of this year, first part of
Right.
2023. Well, here we are almost the end of the first quarter, and we've got some things that have to deteriorate further. Job market, spending, those things before I think we would ultimately dip into recession. I mean, it has, at its simplest form, consumers have to stop spending, right? I mean, or have to cut back on spending, be it from job losses or just inflation, what have you. So I think the goalpost, the term the goalpost has moved in terms of the timing of when the recession is going to happen. Definitely has been moved and pushed back and debated around. But here we are, almost the end of the first quarter of 2023. So we will see. I mean, Greg mentioned the different landing scenarios, and it is, and we've talked about this before too. We've never dumped trillions of dollars into the economy like we have over the last few years, and then been able to see and observe what happened. So we're working our way through that. Rates have increased. We've got a tighter money policy. Interesting though, one more comment, and then we can move on. The GDP numbers, the economic growth numbers for the last 2 quarters of 2022 were very positive. I've talked about the 2.7%, and then the third quarter was 3.2% annualized. But we had negative numbers for the first 2 quarters of the year, which that's when the recession term started being batted around, because historically 2 negative quarters of GDP is recession. So, and that, I think that has attributed to the most anticipated recession terminology as well. But anyway, as we go forward, we'll all of these things, I think I know we're paying attention to, but they will determine, what is the outcome and where do we land. Ultimately, inflation and the Fed has a big role in that. And that's why, just highlighting the headlines over the last 8 to 10 days, I mean, if the Fed's not going to hike, or if they're at the end of the rate hike cycle, and they're, more attuned to, the possibility for deteriorating conditions on the bank side versus inflation, then, that puts a different scenario than another, point of hiking into play. So all that to say, we're any of those one of those scenarios, to put all of our eggs in one basket at this point is not prudent. We really have to be attentive to what we see going forward, and then react accordingly.
Yeah, and the big thing that we don't want to miss here is that the innovative engine that is the U.S. economy really powers the world. And, whether it's in healthcare or even, thinking about future forms of energy, we can't lose sight that growth happens from innovation. It wasn't 2007 that we all became familiar with an Apple iPhone or a smartphone in the form or fashion that's in today. And so there's any number of stories that we can tell. I mean, I just shared with the team over the weekend a drone type delivery system that's getting patented and is in the process of delivering food to your doorstep. So, I mean, any number of those type of stories are out there for the third world even to be able to take and convert dirty water into clean drinking water is available for a fraction of the cost that it was just 10 years ago. So I'm very optimistic from that standpoint. Also realizing that the US consumer drives the economic car. That's about 70% of the equation. So we still see growth there. There will be a time probably if rates continue to rise that there will be slowing in spending, and that's okay. We know that happens. It's not something that we should abandon a well thought out investment strategy for. And this chart is proof of that. You know, there's any number of reasons that you would have stayed out of good quality investments, but had you done so, you probably would have done so at the detriment to your financial health. The sleeping giant is inflation, right? So prices rising. The next slide is really one that keys on volatility does not equal a financial loss unless you sell. And you know, the market has all kinds of stories of investors who have done this. But if you go back to 1983 and come forward, that's the left side of the page to the right side of the page. The gray bar shows where the stock market, as related by the S&P 500, ended the year. And so the annualized return over that time period was 15.4%. The green squares underneath are described as an intra-year price decline. So the worst sell-off in that specific year. And in fact, every year had an intra-year sell-off, even the years that were positive. So the meaningful thing there is the average, or the median, as in this case, is 10%. Last year we saw that, didn't we? 2022 was not favorable for equity investors or even a balanced portfolio. But what we know that over time, unless you sell in those lows, you do make that back, and that tends to be the case over well diversified portfolios. The odds of you having a successful outcome over time go up dramatically the longer you're invested. So, and not everyone needs to be invested in a equity portfolio or a 60-40 portfolio. We realize that, but this is just historical perspective to help you see that over time.
And that brings us to some key takeaways. We just wanted to highlight a few bullet points here. Starting with the first there, just limiting individual equity positions to 5% or less. We don't want to be concentrated with too much risk in one position. Case in point would be with just the recent news with the banks. You're subject to headline risk if you've got a lot of money in one individual equity position. And so we talk about diversifying if that is the case, to try to limit exposure there. The second bullet point there is sector diversification. Similar, kind of related to that first bullet point. We don't want to be, if somebody was overexposed to the banking sector, they have seen some volatility over the last week and a half or so. But we want to be well diversified across a lot of different sectors, so that as things happen to one sector or another, and it can go both ways, right? I mean, there's also positive things, and as Greg talked about, innovation and developments in technology, you can benefit in a positive way from being involved in one sector. But going back to the not putting all of our eggs in one basket, that's the principle of diversification. All the more important in today's market. Staying within FDIC insurance limits, Tara kind of talked about those limits, but we would encourage people not to panic and go take your money out of the bank. If you're within those FDIC insurance limits, which are, as she said, $250,000 per individual, per registration, per institution. So there's ways to spread out the risk even within the same institution by different account registrations. But for most people, you're going to be within that 250,000 balance on the FDIC insurance. The next bullet point there, look to improve interest on cash. Greg mentioned just with the rate environment, the rate increases, there are opportunities in the short-term market in terms of cash alternatives, be it CDs or money market accounts. And we would encourage you, if you've got cash that's sitting in the bank earning less than 1%, there are much better alternatives out there to consider, even fully liquid alternatives in high yield savings or money market accounts. And then finally, just staying focused on your goals. Greg kind of touched on this as well, but just knowing as an investor with money that is put to work for the long term, that it's not 100% of the time going to go up. There will be some ups and downs, but that over time, the investors that have been able to be patient, to stay invested, have benefited greatly over time by being an investor. And so that's where we come alongside you to help with the management and oversight of that, trying to mitigate and manage through downside risk, but also take advantage of opportunities where there's upside potential. Did you guys have anything else to add there?
I think that's good. I mean, folks just realize, if they have questions, to call us. We're here to help and offer a path forward.
Yep. And then as we always have done since we started these webinars, just to close on some biblical wisdom and truth, and pull these few verses just from Matthew chapter 5. This is Jesus' Sermon on the Mount, where he's talking to his disciples. Verses 14 through 16, he says, "You are the light of the world. A city set on a hill cannot be hidden, nor do people light a lamp and put it under a basket, but on a stand, and it gives light to all in the house. In the same way, let your light shine before others, so that they may see your good works and give glory to your Father who is in heaven." And I think there's a lot of a negative that you could focus on in the world today. But what we're trying to do is here, as the team at Atlantic Wealth, is to try to be a light in the midst of all of that negativity, and to shine a light not on us, but on Jesus, who really deserves all the glory. So appreciate the opportunity to share that with you this afternoon.
And we thank you for joining us. That was a lot. I know if you have questions, feel free to email or call us, and we're here and at your service. We consider it an honor and a privilege to serve you. And we do record these webinars. It takes us a few days to a week to get them approved, maybe even a little bit longer. We have to send them through compliance. But once they do, we post them up on our website. And we would encourage you to send them out to your friends and family, people that are your loved ones. And hopefully they add value to your life and to those that you know and love. So continue to pass it along. And we look forward to seeing you at the next one in April. We do have an event called our annual shred event coming up in April. Stay tuned for an invite. We're going to have a shred truck over in the Baptist Church parking lot, some Chick-fil-A biscuits and sandwiches. And we're going to look forward to a little bit of opportunity to shred up some of those documents you have. Hope you have a great tax season and enjoy your week. And we'll see you soon at our next meeting. Bye-bye.
Bye.
Bye.